I'm Jim Cunningham. I have Christina Lindsay from Ascent Wealth Management here today. And today we're going to talk about building the best financial team. And this is selecting the right advisors, lawyers, and CPAs for your A team. And if you've seen any of these before, what we're talking about is the A team from the 80s, right? With Mr. T and the George Peppard guy who loves it when a plan comes together. So disclaimer, I'm a lawyer. I'm talking. This is not legal advice. Christina, once I stop talking, she'll start talking. Once I let her say a word, she's a certified financial planner, securities and insurance licensed. But this is not advice. This is just information. So don't watch this and be like, well, Jim and Christina said, and go out and do a bunch of stuff. If you're watching this on YouTube, go ahead and hit the subscribe button. It's very important that you subscribe to our YouTube page because this does appear in your feed and we do release content weekly. And it's frankly very high value content. That's the feedback we're getting from our clients and our friends. And let's talk about having an A team and the importance of an A team. Christina, I've known you for 20 odd years.
Mm-hmm. Yep.
And I know that we talk about this a lot. You and I work together with many clients, not all clients, but we work together with many clients. And we know the importance of this analogy of a three-legged stool. If maybe you can help walk the viewer through this, right? The person who's watching this video, what are we talking about with the stool? What are these three legs and why is it important?
Absolutely. These are kind of the three main components to who should be part of a client's team. And not to say that you don't necessarily need other advisors, because sometimes we do need additional advisors, but these are the three core components of what makes up a good team when advising a client more comprehensively and holistically. And being a three-legged stool is critically important to make sure that you don't have a CPA, for example, that's also doing the financial advice and doing all the investment advising, because there are some out there that do both. And ultimately there ends up being a conflict of interest in either recommended products that are commission-based or limited solutions. And then you also have a CPA that's focused during tax season on their taxes, and they're not necessarily looking at the entire investment portfolio. So you don't want any one of these entities to do two of the same things. You want an independent attorney, an independent CPA tax advisor, and an independent certified financial planner. Now, there's going to be some caveats to this. There's going to be some exceptions to this, but for the most part, you want a three-legged stool. You don't, if you just have two components of these, you're not going to have a properly balanced stool. It's going to fall. There's going to be something that's going to be incomplete in your plan. And I've seen CPA tax advisors try to do that aren't attorneys, try to do incorporation corporate documents, and they don't keep the minutes, they don't keep the statement of information up to date. So there's always inevitably going to be a failure to where your stool is going to fall if you don't have three independent parties working comprehensively on your plan.
Yeah, I think you mentioned something really important is, there's this concept of staying in your lane. So one of the things that we do in our law firm is we only do legal work, right? We don't do financial advisory work and we don't do tax preparation. Now, some law firms do tax preparation. I would say, sometimes you will see that. I do see some CPAs who do the financial advising for their clients. I agree with you. I think they're probably biting off more than they can chew just because of the nature of the work, because you get very sidetracked during tax time. By the way, tax season starts in March and ends in October. I don't know if you're watching this, if you're aware of that, a lot of people extend their returns. Partnership returns are due at a different time than an individual return. And so what ends up happening is tax season can be, a March to October, which is 7 months, right? So it can be a very long period of time. And the important thing about perspective, I want you to look at this stool. So I'm the estate planning attorney. I can see the CPA, I can see the tax advisor. There's also gaps between the legs. And I think this is where a lot of people get into trouble, is on these gaps, because there is an intersection of knowledge with law and tax, but there's some things that come up that are in between. And the example that I'm going to give is, we were meeting with a client a couple of months ago. We had all the advisors in the room and we figured out a way, literally by turning it, the analogy would be turning a screw a quarter turn. And by making a distribution from a trust to the client versus keeping that property in the trust, really it was the timing of the distribution more than anything else, because the money would have come out anyway. But because we chose different timing, it saved our client $300,000 in income tax.
Correct.
Now that's a big number. And that is, that's definitely a high value add in that relationship. And I will tell you, I would not have seen that if I was handling the whole aspect. You wouldn't have seen it. And the CPA would not have seen it. It took the three of us.
It took the three of us.
Yeah,
and
right.
in addition, because this was a very, very large client, we did have a corporate trustee, which we'll talk about later in the presentation, but we also had the corporate trustee involved. So not to say that we won't have additional advisors, because in this case we did, but it took all four of us advisors, each staying in our lane, to collaborate together and finding the best outcome for the client.
And, another thing is that if you say, well, I think I'm going to do my own estate plan, I'm going to write it myself, I'm a smart person, or I'm going to do TurboTax, or I'm going to handle my own investments, I think I can do this on my own. The problem is you don't know what you don't know. You do not know what you do not know. And it takes an expert to see what's missing. Now, what I mean by that is you can look at something and go, that looks wrong. Okay. But if you're not an expert, you don't know what's missing because it's not there. And the example, I was meeting with some clients this week, and I gave them the sad, sad news that because they had missed a deadline for filing a death tax return, a 706 return, the estate tax return, it's about $2 million in penalties plus $500 a day in interest. And they totally misunderstood how much could be passed tax-free because it's when the people passed away. And that's something that I immediately saw. The family was focused on another issue entirely, but the associate attorney who was with me on that call, we immediately went, wow, the biggest issue you have is this unpaid tax liability. And they were totally blindsided because they were kind of doing it themselves. So I would say if you don't have much, the consequences aren't as great. The more you have, the bigger the consequences.
Absolutely. And Jim and I know the downside of someone preparing their own trust. That's exactly how Jim and I met 20 some odd years ago, when Jim had to represent me because my grandfather decided to write a homemade trust and my uncle sued me for my college funds. So we know when things are not done properly, and which is why we work so closely together to make sure that we're working in the best interest of our client.
What's a wirehouse?
Great question. So back in the day, they used to send the trades, they used to tap the trades over the wire. And so it's the big banks. They're known as the wirehouses, which would be your Wells Fargo, your Charles Schwab, your Morgan Stanley, your Edward Jones. And so those are the big wirehouse bank type investment institutions where they service retail investors. And typically the average tenure of that retail advisor in a wirehouse is about 2.5 years of industry experience. And not to say that there aren't obviously other ends of that spectrum, but you typically don't have long-standing tenure. You have a lot of turnover in that space. I think Vanguard keeps their average advisor less than 2 years. So there's a high amount of proprietary products. All of the advisors that work for those big banks are not necessarily even advisors. They could be simply security licensed without having an advisory license to advise. They may or may not be CFPs. And typically they're employees of those big banks. And so they are incentivized as an employee to sell certain products. Another example that would not necessarily be a wirehouse, but an insurance company. So a Northwestern, a New York Life. And oftentimes when you're dealing with an insurance company, they're not necessarily known as the wirehouses because they're not doing a lot of necessarily mutual funds or investment products. Sometimes they are. But those insurance companies, you're dealing with insurance licensed brokers that are salespeople, and they are incentivized to sell the proprietary product of their employer.
Yeah, for every hammer, there's a nail, right? and everything's a nail. And so the solution is a hammer, which is one type of product. When, as we know, there are many different types of tools when you're going to build something. Can you explain what a product is and also what proprietary means?
Yep, proprietary. So, for example, I'll pick on Fidelity for a moment. Fidelity, they're.
You're taking no prisoners on this one.
I'm not, and I've worked with the wirehouses. I worked with Edward Jones for many years. My father was at Edward Jones for many years. I also was a wholesaler and brought product to financial advisors, and so I know both sides of the coin. And one of the reasons why we left Edward Jones in 2012 was because we wanted to be able to offer more independent, holistic advice with no conflict of interest. A product could be a mutual fund. A product could be an annuity. A product could be an insurance policy. It could be a number of different things. But if you have a Fidelity advisor, you're more than likely going to have Fidelity mutual funds in that account, in that portfolio. And it's not to say that Fidelity has bad funds. They have some phenomenal funds, but it doesn't mean that every single piece of your account necessarily should be for if you need a large cap growth allocation or a mid cap growth allocation or a bond fund. It doesn't need to all be Fidelity funds. And same thing when it comes to Vanguard. If you have a Vanguard account, it's very likely you have a lot of Vanguard funds. And sometimes we use in our portfolios Fidelity funds, Vanguard funds, if they're the best in class for that asset class. So
so I really want you to explain this, because I think some people might say, well, it doesn't really matter where I go. Charles Schwab has a fund, Fidelity has a fund, Morgan Stanley has a fund, Edward Jones has a fund. Don't they all kind of give the same return? Isn't it kind of the same? Does it really matter?
And they don't. And that's really where, the reason why you have Fidelity funds, if you're at Fidelity, and Vanguard funds, if you're at Vanguard funds, is they're getting revenue on that. And there's hidden fees. And oftentimes if we run a comparison and we look at we've done a webinar on this, we've done a webinar on risk adjusted return, and we've looked at a portfolio that is exclusively Vanguard funds. And this won't be the same outcome every time, but we can look at it and say, okay, this client took 2% more risk per year than they needed to, and they got less returns. So net of fees on a 10-year average, a portfolio that we compared it to as far as what our recommendation would be, they made 2% less per year on the 10-year average. And they took they took about 40% more risk. So they didn't need to take that much risk and be subject to that much volatility in the market, because the Vanguard funds had more risk, less total return, even if their fees were less. So sometimes, there's hidden fees when you have proprietary products. Sometimes there's excessive risk, lack of active management. So it's not exclusive to one firm or another. Insurance products, typically, Northwestern Mutual or New York Life, they're typically inherently more expensive than finding a independent insurance product like a Lincoln policy or a Prudential policy. And the nice thing is, because when you're an independent advisor, you work for yourself and you can represent a multitude of the companies that are out there in the industry. And you can truly pick the best of the best products, services, whatever need your client has. If I have a life insurance need for a client, I can go to the marketplace and go, okay, who's the best at this moment in time? Is it Lincoln? Is it Prudential? Is it, Berkshire Hathaway? Is it, Symetra? Who is the best at this moment in time with no conflict of interest or no firm or wirehouse or parent company saying this pays the company more, your compensation's based on this product. And so that's really what we mean by conflicts of interest.
What about a bank versus a corporate trustee? Maybe if you can talk a little bit about, you can go to, XYZ bank that has a trust department versus a trust company. You want to cover that a little bit?
Yeah, that's a big one. a lot of the big banks do serve as corporate trustees. Northwestern, Wells Fargo, those are a couple of the big ones, UBS. And inherently, there's conflicts of interest, because if you are serving as the trustee, you're the fiduciary over those trust assets. You have an obligation to serve the will of the trust, terms, and the will of the needs of the beneficiaries. And so if you have beneficiaries over here that need distributions for XYZ, the trustee might think, well, if we give too much in distributions, we're losing revenue. And we can make more money for the bank if we have the funds that are in this trust invested with one of our advisors. So the financial advisor is getting a fee, they're charging a trustee fee. And then if we put it in our own products, we'll get even more revenue, because we get a revenue share on the mutual funds if we put it in our own proprietary funds. And so there ends up being a lot of different layers of fees, and they see those assets as their assets, versus if you have a corporate trustee, you really want an independent trustee. You want a corporate trustee that has zero conflict of interest. They don't manage money. They'll work with your advisors or your preferred, advisors that have worked with the family for years or whomever. And it could be a big bank, it could be a wirehouse, but having a corporate trustee have that distance is going to lower the amount of typically fees and lessen the risk of conflicts of interest. And when we have a corporate trustee, we use one in the state of Nevada that does not subject the trust to state income taxes. They have phenomenal asset protection rules in the state of Nevada. They've got great laws. And not only that, they're typically very independent. They can make decisions quickly. If you've ever worked with a bank trustee and you've tried to get a distribution, they have to go through their board approval. And how long does that take? Typically 30 days to get a distribution with a big bank. Working with a truly independent corporate trustee, you should be able to get an answer and distributions through a board approval within less than a week.
All right, we've got a few questions. Richard asks, how do trust companies differ and how do you select one? Well, as Christina mentioned, there are two types of trust companies, ones that are attached to a big bank with a lot of proprietary products that they're going to sell to themselves and while they're running the trust, versus a trust company, which you will see trust companies. There are a few in California, but primarily they're going to be in the zero tax states such as Nevada, South Dakota, Alaska, Tennessee. That's where you're going to see a lot of them. And it's also difference in fees. So typically your trust banks are going to charge 2 or 3 times what a trust company will charge, on top of making money on the mutual funds that they're going to sell you. So when you kind of strip away all of the layers of baloney on this stuff and you look at it, what you're paying to that trust bank is a lot more than you probably realize in many cases. The advantage of going with a trust company with an independent financial advisor, there is transparency in fees. And the world is changing, okay? The financial world is changing. I can't tell you how many clients, Christina, I've talked to, and they say, oh, I've had my guy for 30 years. He's great. He's 72 at a wirehouse. And, these clients are sitting on a big IRA. And I've asked him, has your advisor ever talked to you about a Roth conversion, which we'll talk to in a little bit, but there are a few reasons why that's typically not brought up with many wirehouses. They're typically not prompting their clients to do Roth conversions, which I think is a big miss, quite frankly, and something that a team and a team, right, this three-legged stool would pick up on.
Well, and I want to hit on one other thing for a moment before we hop off this on the corporate trustee. You and I have worked on a mutual client for many years, and we saved them $300,000 a year in trustee fees alone, just moving from a big bank trustee to an independent trustee. But not only that, we uncovered that half of the entire client's net worth was tied up in illiquid proprietary funds that the bank was trying to hold the client hostage. If they left, they would have had to recognize significant capital gains. And so they treated the client poorly because they knew they could get away with it, because if the client left, they'd be forced with a huge tax bill. You and I helped solve some of those problems. But that's another thing too, that you get down the line and you realize a lot of these are not truly in the best interest of the client, and it makes the client feel like they're held hostage.
So can you please give examples of corporate trustees for all states in the US? Now, these trustees are typically chartered. They're either state chartered or nationally chartered. A national chartered trust company can operate anywhere in the United States. A state chartered company can typically only operate in the state of its charter. So Premier Trust is one. I believe there's another one. It's just escaping me at the moment. Another one in Nevada.
There's several in Nevada that we've used.
The corporate trustee is Premier Trust. That's the one we've used. So you can go to their website. You can see their fees. You can see who the people are. I want to say they have about 40 employees, something like that. It's kind of, we go to the court headquarters frequently, and it's in Las Vegas, and it kind of feels like an accountant's office. I mean, it's not like a bank at all. And then how do you select between trust companies? I would say talk to them, right? So if you're looking in Nevada, I would interview a few of them, ask them who your trust officer would be, and see if it's a good fit. Okay. Is a corporate trustee the same as an individual trustee? I would say yes, that they're both trustee in that sense, but a corporate trustee versus an individual. An individual trustee, you can have a private professional fiduciary, which is someone who's trained, or you can just name your kid who's never done it before. And again, this is part of you don't know what you don't know. You can get into real trouble by naming an individual. If they are empty of head and white of heart, and we use that term in law school, which means they don't, they don't have a lot of knowledge, right? But they're a really good person. That may not be the best person, okay? Because you need someone who's knowledgeable about finance, who's knowledgeable about what it means to be a fiduciary. Now, a fiduciary is the highest form, the highest duty that is owed to somebody else under American law is being a fiduciary. You have to put the interests of the beneficiary, the person you're serving as a fiduciary, above your own interests. Christina is a fiduciary. She's a registered investment advisor. The wirehouse people are not fiduciaries. Banks, not fiduciaries. They do not have to put their interest, they don't have to put your interest before theirs. So that's very important. Now, sometimes you will get registered investment advisors. And certainly when a bank is serving as trustee, they're supposed to put the interest of the beneficiaries first. But what we see in the real world is they're selling proprietary information or proprietary investments and double, triple, quadruple dipping and getting fees on fees. We had another question. Stephanie wrote before we started, do you think it's important for your CPA to have some kind of smart vault to put documents in versus just emailing them? And Stephanie said, he sent me a regular Dropbox. Christina, you said that Dropbox is not, with your compliance people, is not up to par. I think it's better than emailing an attachment. But in our law firm, we use a Citrix product called ShareFile. And I think you use ShareFile, don't you, Christina?
We use ShareFile as well. So Citrix ShareFile is approved. It is secure. It should always be encrypted no matter what. And Dropbox is more secure than emailing it. But for our industry, Dropbox is not an approved vendor as having the most security.
Yeah, it's something you need to understand about an email attachment. If you attach something to an email, it ends up on a bunch of different servers across the world. Okay. And it's very easy look, we got a phishing email today in our law firm. Phishing, P-H-I, or however it's spelled. You're going to get those, right? I mean, it just happens.
Yeah.
This is the world we live in. Is Comerica Bank and Trust National Association a good corporate trustee? Comerica, I think, has a good reputation. They're a national bank. And so we happen to be in California. We are hypersensitive to state income tax. If Comerica is your trustee, you do lose, in my view, or my personal view, I think you lose a lot of tax planning options versus going with a Nevada trustee or an Alaska trustee or a South Dakota trustee. What if you want your kid to have the final say in trust decision-making, but they need oversight? Should you make them co-trustees? You could. You can also have, what we do in estate planning is we can have an advisory committee. Okay. You can have an investment committee. You could, you can write your trust however you want to write it. But I think that's a very important conversation to have with your Pick a trust company, have that discussion with the trust officers and somebody like Christina and somebody like me and the CPA. And it sounds to me like it may be a training issue, and maybe not a personal problem issue. You know what I'm saying? All right. Anonymous also asks, we are a couple and would like to establish an irrevocable trust primarily for asset protection. Does your firm establish trust of this type? Yes. Is it better to have a corporate trustee in your state? How do you select a good one? So here's where Christina and I have experienced this. If you name a Nevada trustee, they are not going to, literally, they're not going to set foot in California. Not going to happen. They're going to be in Nevada. And the reason is they would then start potentially subjecting their trust company to California taxation, like the whole company. So here's what they do. If you own securities, now what I mean by security is stocks and bonds, mutual funds. Those are like a national, those are considered nationally chartered. Those can be with the Nevada trust company. If you own real property in California, they're typically not going to be the trustee. If the real property is owned by an LLC, they can be the trustee of the LLC because it's an intangible. So I think the short answer is the trustees who are in these zero tax states don't deal with assets that are located in California, such as real estate or money at a state chartered bank, which is a little quirky exception, but they will handle everything else. Anonymous asks, is Schwab, Vanguard, or Fidelity acting as trustee considered to be a corporate trustee? Yes.
And that would be a bank trustee as well. That could be a conflict of interest. So you typically don't want a corporate trustee that is also serving as a financial institution.
So let's do this. Let's talk about what you can be missing, right? If you don't have this great three-legged stool. What if you have a two-legged stool? You don't have a stool, you're falling over, right? So what are you missing out on? Let's talk about all the good stuff that's out there.
So these are things that typically when we are working together as a team with the client and then also bringing in the CPA, we're able to do truly more comprehensive planning that, again, with the wirehouse might be limited exclusively to portfolio management or choosing investments or retirement income planning. But what we really want to be when we're comprehensive and holistic is looking under the hood of every aspect of that client's financial need. We do real estate cash flow analysis. Should there be a potential recommended sale of a property? Are they getting the right cap rate? Could they defer capital gains by doing a 1031 exchange? Is that in their best interest? Doing mortgage analysis, refinancing. I can't tell you how many clients I've referred that I've looked at their whole situation and just go, you guys really need to look at refinancing and doing things in a way that would be more tax advantaged for the client. So for example, in this real estate market, there's been a number of clients, as many of you know, trying to buy a home these days, unless you're an all cash offer, is really difficult. And unless you're willing to pay over ask. And sometimes clients don't have that flexibility until they've sold their existing home to get that liquidity. And so sometimes what we've been able to recommend is potentially even taking a margin loan. And because we're dealing with institutional rates, we can deal with typically 2.25, 2.5, on a short-term margin loan where you don't have to sell a bunch of liquid assets, recognize taxable gain, or liquidate an IRA in order to be able to put yourself in a position to buy something all cash and then pay it off once you've sold your home and replenish the margin account. So having someone really look at things more creatively, looking at should there be a mortgage taken, should someone pay all cash for a property? What does that impact to their overall retirement plan? If they were to buy a property all cash and limit the amount of liquidity they have because they're debt averse, is that necessarily in their best interest or jeopardizing their long-term retirement plan?
Christina, can you explain what a margin is?
Yeah, a margin loan is just taking a loan against your existing securities. So if you've got Apple stock or a mutual fund or Microsoft, and let's just say you bought it for, $100,000 and it's now worth $400,000. If you sold that and because you needed to get cash, you'd have a $300,000 taxable gain. And whereas you could technically put a margin loan against those assets, typically up to 50%, of the value. And so we wouldn't necessarily recommend going up to the maximum, but we have to look at each client situation and figure out if it's even suitable for them to take a margin loan. But in some cases, we've been able to take a margin loan where they don't have to recognize that huge taxable gain. It might only be for a period of 90 days. So they've avoided tax. They can pay it back once they've sold their home. They can purchase the new home all cash, whatever the needs might be. But this is really where having a team working with the CPA, working with the client, looking at things more creatively, and then having a tax efficient portfolio structure. I think that's gifting, charitable strategies. Those are also really important. And it really comes back to tax, because certain gifting and charitable strategies are typically tax avoidance types of strategies, not tax evasion, but tax avoidance. And tax avoidance can be critical when looking at what's going to cause a tax implication. Certain strategies didn't exist to us in a wirehouse setting. Part of the reason why we went independent, we couldn't do things like an RCLAT. We couldn't do things, we didn't have the tools and the team to do certain types of sophisticated tax strategies to offset for Roth conversions. Sometimes there's a tendency to have a lot of mutual funds. And what I've seen in some clients' accounts that we've brought on, they might have had a lot of mutual funds in a taxable account. And not that that's a bad thing, but there's a difference between an ETF and a mutual fund, and they're taxed differently. And we can talk about that a little bit more. I think we actually have a slide on that. But
yeah, let's do this. I do want to mention something about and here, this is a classic example of the different perspectives that lawyers and financial advisors have. When you borrow, on Christina's example, if you have a portfolio of Apple stock that's you paid 100,000 for is worth 400,000. Many people, if they say, "Oh, I want to buy a house for my kid," all right, I'm going to do a down payment or whatever it is. A lot of people's initial reaction is, I'm going to sell that stock and pay because that's what it was for, and that's what I want to do. But I would say that a more nuanced, sophisticated approach is to borrow, as we've indicated, but now as the estate planning attorney's perspective, when you die, or whenever the person who owns that stock dies, in most cases, if you own that stock, right, it's in your name, if it's in your living trust, you die, that stock gets an adjusted cost basis. So what that means is your kids can sell that stock that you paid 100,000 for 400,000 if it's worth 400,000 when you die, and not pay any tax. Mm-hmm. This is why when you hear rich people, there are different ways to say this that are political ways of saying it, but the fact is, I think rich people pay a lot less tax than they otherwise would, because they get really good advice, because number one, they can afford to pay for it. Okay. And secondly, they actually take the advice. Okay. So I think that's why rich people pay a lot less in tax. And that annoys some people in politics, and other people are okay with it. We're not going to, and we're not talking politics. This is completely politically neutral, but this is an example of having a longer term view of your wealth creation and what this wealth is for, and who's it for, and your goal of minimizing taxes. I think we can all agree on that. We want to minimize taxes. We do have a couple of questions. Richard asks, do you have an opinion on use of DST to get real estate out of California? DST is an acronym. DST means two different things. I'm not sure what you're talking about. It's either a deferred sales trust, which is under heavy scrutiny from the IRS, or something else that's called the Delaware Statutory Trust, which is not getting that scrutiny. But the answer is, I have an opinion. It depends on what it is. If it's a deferred sales trust, I know an attorney personally who's going through about 15 audits. Okay, these kind of blew up with one provider. Susan asks, is a margin loan similar to a portfolio loan? I would say a margin loan. It is in your parlance, Christina.
Yes.
It's similar. Okay. Yeah. So you're borrowing money, and the security is the stock. And, let's talk about Roth conversions and maybe why wirehouses don't. And here, Delaware Statutory Trust. Richard. Okay, good. If it's done correctly, That's way better than the deferred sales trust. Okay.
Yeah. And a Delaware statutory trust really just needs to be analyzed. And that's really kind of going back to the initial bullet point of doing a proper real estate cash flow analysis, analyzing your true cap rate, your true rate of return after your tenant improvement costs, after property management. Does it make sense to hang on to that property? How does it meet your overall income needs? And so sometimes it could be a solution to recommend a 1031 exchange into a Delaware statutory trust, but it's got to be analyzed at the client level. So, and there's a number of them out there. Is some are good, some are bad. So it really just, you need to have a proper team. But Roth conversions, you mentioned, Jim, sometimes doing Roth conversions, one of the things we mentioned was going from accumulation of wealth to distribution of wealth. And a lot of times people, when you're in that accumulation of wealth stage, it's save, 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 save. And they don't really prepare for that distribution or how to reposition their portfolio for distribution and tax efficiency. And then all of a sudden we might be staring down at the road at these very significant required minimum distributions. And those required minimum distributions are set by the IRS at age 72. Now that may get pushed out to age 75, but the longer it gets pushed out, the larger they're going to be. And if you've got, several $1 million in a 401k or IRA, those are going to be fairly significant required distributions. And there's some technique when it comes to planning for those Roth conversions. We do have some software and some modeling that we would do for our clients to show them, does it make sense to accelerate some of those taxes into certain years? Maybe you've retired early and you've retired at 62 or 58, and you've got several years of low income earnings before you have those required distributions kicking in. Maybe we can accelerate some of those income streams and doing conversions. Now, there is a lot of pending hairy legislation on what is going to be our availability to do future Roth conversions. I do see some of those backdoor Roth. The backdoor Roth is probably going to be closed. That's where you could contribute a non-deductible traditional IRA, then immediately convert it to a Roth IRA.
You're going through, Christina, you're going through this really fast.
Hold
on, you're an expert. You're an expert.
Yep.
But here's the benefit of a Roth. And, we covered this in last week's webinar, and it's on our YouTube page. I would really recommend that you take a look at it. And basically it's, can you retire in California? What I'm making the case for retiring in California. The benefit of a Roth is there are no minimum distributions while you're alive. So if you're basically kind of taking all the money out at once, or half of it, or a quarter, or whatever it is. You're paying the tax at one point in time, but you do not have minimum distributions in the future. And any money that you take out or your heirs take out, there is no income tax on that money. Right. So those are really huge benefits. And it's important to model this out because
you have to model it.
This is a math puzzle. Okay. And we gave the example of some clients who retired at 60 and basically traveled the world for a couple of years. You can go to France and Spain and Italy and Mexico and Florida and Nevada and travel for a couple of years. And guess what? You're not a California resident. You can remove yourself from California. And we cover that, the things you have to go through, but you can actually do the Roth conversion when you're not a resident of California and then move back to California and you have a Roth. So you've successfully avoided the state income tax. And those are the rules. Okay. And that's what many of our clients choose to do. And they live off their cash savings effectively, right? During those years that they're traveling, and they're not withdrawing from their IRA.
Right.
So
Roth is super important.
Yeah. So let's look at our case studies here.
These, before we get into, I think we have a couple of quick case studies, but I think some of the things too that we just said is, commonly overlooked opportunities, which is when you have a full team. We talked about investment strategies. We've spoken about a lot of these things already, but in your investment and strategy, making sure there's limited use of proprietary funds. Sometimes they're not all bad, but that could be a red flag. Appropriate risk in the right account. So I mentioned mutual funds. Mutual funds are typically more tax efficient. If you want to make sure that there's tax efficiency within the mutual fund, and if it's causing capital gains and unnecessary taxes in a taxable account, they'd be probably better suited in a tax deferred account. We've seen municipal bonds, which are state income tax free and federally tax free, be used in an IRA. And there's sometimes not necessarily the best benefit for that, because you don't pay tax. It's tax deferred in an IRA anyways. So having the right level of risk in the right accounts, having typically higher growth in something that's tax deferred or tax free, and having maybe lower risk and more tax efficiency in something that's a taxable account. Not considering IRD. IRD is income in respect of the decedent. So income that has been deferred by the decedent, an IRA that gets inherited, that is income tax that was deferred. There's no step up in basis. There's never been taxes paid. Planning for that IRD. Sometimes there's going to be very significant inherited IRAs that are going to not only be included in the gross estate for estate tax, which those limits are going down in 2026, and then having to pay income tax as well. So planning for these things, having a very comprehensive plan, working as a team, we can deliver the best solution to the client and look at proper inheritance strategies as well. So it's not just necessarily the current client, but it's what's the legacy wishes and what's going to be the next generation. What do we need to plan for when it comes to inheritance?
Yeah, this IRD is really important. And if you have a larger estate, please listen to this. If you have a large estate, if you got a $30, $40 million estate, $20 million estate, and you have retirement accounts, when you leave what you have to your loved ones, is if it's not a charity, if these are people, okay, those people are going to have to pay death tax on the full amount of an IRA, even though the money in the IRA ultimately will be paid in income tax. So you are definitely taxed twice. So let me give you an example. If you have a $10 million IRA, to make the math easy, your heirs are going to pay $4 million in death tax on that IRA. They're also going to pay, half in income tax.
5 million in California.
Yeah, I mean, it's so pretty much most of this goes in tax, and this is real. Okay, this is not fake. If you are a very high net worth individual, really look really hard at the Roth IRA conversion, because those taxes are paid and they're not in your estate. So you're not the money that will be going to tax. Okay. You don't want to have to pay death tax on money that will be paid out in income tax. And I would say, some practitioners characterize IRAs as toxic assets. I wouldn't go so far as to say a toxic asset, but I think if there's any single asset that needs a lot of attention, it's your IRA and your 401k. I would say those assets need the most attention and they require the most expertise.
And that's really where we also see quite a few estate planning administrative misses when you don't have a team working together on trust administration or making sure everything has the appropriate beneficiaries. We've worked on cases where your team did some beautiful IRA trust planning. We took on a client, and before coming to our firm, the former firm that they were with changed their IRA trust to being an individual beneficiary again, because the firm didn't allow for trusts to be named beneficiaries. And then all the planning that went into their estate plan was jeopardized by the custodian that held the IRA and how they treated the beneficiary designation. So having a coordinated team is critically important. If you're spending the money and the time to have a well-documented estate plan, you need a team, a financial advisor, and a CPA that knows what you're doing. And I've seen clients list trusts, regular living trusts, as a beneficiary of an IRA. And there's very few circumstances where that makes sense, because it doesn't leave the beneficiary as many inheritance tax efficiencies unless you're doing an IRA trust specifically. So these are things that we work together on, making sure that there's proper coordination and making sure that your financial advisor understands the type of estate planning that you're doing.
Yeah, thank you for that, Christina. We have a couple of questions. I do want to say, just for clarity, leaving your living trust as the beneficiary of your IRA, we just don't do it in our firm. Okay. This is an argument, intellectual. It's not a fist fight. It's an argument. It's an intellectual thing I go back and forth with less sophisticated attorneys who say, well, no, if you do this and this and this and this, you can do it. The problem is you have to, if there's a big if in there, all these steps, and an IRA trust is a much superior vehicle. It's a specifically built. It's like the difference between a gasoline engine and a diesel engine, right? the IRA trust is a diesel engine. It's a totally different, for those of you who are mechanics, you know what I'm talking about. It's just a different design. Okay.
Jim, for the
And,
sake of time, I know we've got a few questions, but
I
we might
know.
want to just go through a couple case studies and then we can answer some of these questions.
We'll
that we have.
definitely do that. Let me go through. I got a few questions here. If I converted a Roth in 2021 before I heard your webinar on retiring in California, is there anything I can do to reduce California income taxes and or IRMAA? IRMA.
Medicare surtax.
Yeah, I'm not sure you can.
There's very few options to go backwards unless it's an investment tax credit strategy, which is limited to very specific types of business owners.
I would hate to say no, but probably no, but that's something we could certainly, I don't know if they could undo it. I don't know when you did it. Something you could talk to Christina, about. Can you repeat what IRD is? IRD is income in respect of a decedent. Income in respect of a decedent. And that's a quirky thing. Not a lot of people know about it, but it's like if you do an installment sale, you sell a piece of property on an installment sale basis, that's IRD. The remaining obligation under that note, under that installment note, is considered IRD, but you don't have the money to pay the income tax. If you have a $2 million IRA, how quickly does that need to convert to a Roth before the tax laws change? Do you want to
right
talk
now? Right now it's very hairy. I'd be reluctant to give concrete advice. It looks like there's going to be some income limitations on future conversions. It looks like the window of doing conversions is still going to be available to us for some planning. But at this specific moment in time, there is still some potential legislation that could be retroactive to January 1st of this year. Anything that was already done in 2021 is complete. But anything that at this moment in time, we're being very cautious to make recommendations because it looks like there could be a limit on the window of doing conversions at all. That window could be closing in 2029. We've also heard 2031. We've also heard them being imposed income limitations on this. So right now, it's something that we're analyzing, and it just depends on the client. We're looking at it case by case. We're also looking at what legislation is coming out.
And then does having your living trust as an IRA beneficiary make sense for a special needs trust? Anonymous. What we would do is we would do an IRA trust with special needs provisions. We would do an IRA trust, that sort of diesel variant, right, for lack of a better explanation, with special needs provisions attached to it. But that's something, Anonymous, you would want to certainly call into our office. You can talk to Daniel Van Slyke, who has a big heart for special needs planning, and he would be the person to talk to about that. Anonymous asks, is it better not to name a revocable living trust as a beneficiary for IRA, but better to name the children as beneficiary for your IRA? I would say yes, it's better to name an individual person. If it's a large sum of money, and you need to decide what large is, if it's a large sum of money, if it's worth protecting, consider an IRA trust, okay, the IRA Legacy Trust. And if you own an inherited IRA, I thought that was the one time you leave what's left to your trust. That's a case-by-case situation. We'd want to talk to you with about that one-on-one. So you want to go through some case studies here?
Yeah, I'll go through these fairly quickly. But this first one is a client that we've worked on together. And client came in originally for some long-term care needs. We helped them fulfill those needs. Then they started, kind of asking some more questions. We realized that they had Bank of America serving as their successor trustee, as well as their investment advisor and investment manager. The team was out of New York. The client was based in California. And so there were not only some expensive proprietary investments, but the investments and recommendations for the client weren't as tax efficient and weren't paying attention to California state income tax and complications with California. Weren't familiar with California Prop 13 rules and property tax situations and estate planning technique that needs to be implemented in California specifically. And so what we did was we modified some of their outdated trust documents. We also brought in a California CPA so that we've got a three-legged stool. We've got a team working together. We were able to save the client a lot of income taxes, lower their fees, give them a better tax efficient portfolios. So we had this client had a lot of mutual funds in their taxable accounts when they really should have had individual stocks or ETFs. And so these are things that we were able to accomplish for this client. And another case study here would be, I've mentioned this a few times. Before I get to this case study, I think this is a very quick snapshot of the difference between a mutual fund and an ETF. A mutual fund,
what's an ETF?
An exchange traded fund.
What is that?
It is treated more like a stock. And so it can still be a basket of stocks that can be managed by a portfolio manager, but it's got a ticker that is traded like a stock versus like a mutual fund. So on a mutual fund, if you have a portfolio manager of that mutual fund that is buying Apple and selling Apple, if they bought Apple for, $100 a share and sold it for $200 a share within the year at any point in time, that's going to count as a taxable event. At the end of the year, it's going to be a capital gain that'll go as a distribution to the client. And so even if at the end of the year, if you had $10,000 in the mutual fund, at the end of the year, your statement still says $10,000, you might have gained very little. You could still have a taxable event, even though you had no gain, because they sold it.
Or a loss
or a loss.
Taxable event. Yeah.
In the middle of the year, if the portfolio managers are trading, those are distributions if they're not tax efficient. So having a tax efficient mutual fund is critical if you're in a taxable account. Whereas in an ETF, there's no capital gains recognized, since technically it's all considered in one basket as an in-kind underlying sale. So just on a high level, the ETFs are more tax efficient in a taxable account. Doesn't mean ETFs are always better. It just means that they typically are more tax efficient in a taxable account.
Christina, I think what you're highlighting is this is complicated stuff.
Yeah.
The more zeros there are, the bigger the consequences. And I think we want to think things are simple. I think as humans, we want to have this zen that life isn't this complicated, but it is. Mm-hmm. And you have you make a choice. As a consumer, you can make a choice. You can make a choice to do this yourself or use advisors as like a surrogate brain to do this for you. Then the question is, who do you pick? And that's kind of the point of this, is to kind of go through a lot of the issues. Who should be on the team? Who should be on your A team? Which advisors? And then you ultimately need to decide who it is that you're going to pick. So let's look at case study number 2.
Yeah, case study number 2 was there was a bank advisor that was unfamiliar with the IRA trusts. They missed inherited IRA deadlines. They missed taking the final RMD for the decedent. And we had a situation where the husband and wife that were the original IRA owners died within a short period of time. And so they didn't get updated on the beneficiaries prior to the second spouse dying. And so there was missed RMDs, there was missed creating inherited account deadlines. They had to go to court petitions. And so all of that could have been avoided had there been truly coordination and proper care and planning.
I would say, Christina, and I will tell you this, you're watching this video, you're watching this webinar. I'm telling you, there is not enough coordination in our professions. This is just a fact. And what we're trying to do is we're trying to overcome that. We're trying to make it better for our individual clients. But I will tell you, and I know this because I talk to other advisors and I'll talk to other CPAs, and it's impossible to get a hold of them. It's like, how can I do a good job for my client if they won't even take my call, or if it's difficult to communicate with them? Your advisors should have each other's cell phone numbers. Okay. They should be able to text each other. They should be able to call each other on a weekend because this is important stuff.
Yep. I think Jim and I text regularly on our clients' cases, and I know we did with CPAs and stuff yesterday too. So, but risk adjusted returns, we've done a whole presentation on this, but this is also just a quick reminder as, why having a team is important, and not necessarily doing it yourself, or even looking at just a proprietary bank portfolio or wirehouse portfolio. This is just an example of one of the clients that we brought on and compared their past performance to our model that we had recommended for them. And if you look at the 10-year statistics, the standard deviation was 13.5 on their portfolio versus 10.5. That's significantly less risk. And also a little bit less return, but that's net of fees and taking significantly less risk. And so if you look at the 3-year return, you can also see significantly less risk, very similar returns net of fees. And so it also comes down to what the client's needs are. And if we look at this, I think this is the last case study. We might
let me translate this into normal English. One thing that does not get coverage is the risk that you are assuming by investing in the market. Okay. Because putting your money in a bank is less risky than investing it in the stock market. Mm-hmm. You get potentially a higher rate of return, but you could also lose money in the stock market. Okay. So what we're talking about is taking appropriate risk, because you may be taking excessive risk and have no idea that you're doing that. If you just have your money at Vanguard in a mutual fund, you have no idea what the risk is that you're taking. And it takes a certified financial planner to figure that out. All right. Yep. Case study number 3.
Yep. And so this was a client where, we kind of alluded to this in our earlier conversations, but this is one of the case studies that we have worked on with the client. And, this is a multi-million-dollar high net worth client that had been taken advantage of for many, many, many years by the trust company that had proprietary funds that had 50% of their entire portfolio tied up in illiquid hedge funds that were getting fees internally inside the hedge funds, paying the bank. Then the bank was charging a trustee fee, an investment advisor fee, a fiduciary fee. So it was quite significant when it came to the layers of conflicts of interest. So much so that warranted, legal action with the former trust company. But, this is really where bringing in a team that was also catering to the client's California tax needs, being able to reposition things and distribute certain assets that are more tax efficient for the client, more tax efficient for the trust, bringing in a separate independent corporate trustee. We've been able to save the client over, $300,000 a year in fees. And so just doing some of these basic things, but freeing the client from feeling like they're held hostage with the former trust company and treating the client the way that they deserve to be treated, and not just a beneficiary of an inheritance.
Case study number 4.
Yeah, this is another client that we recently have worked with and did in 2021, because we don't know what the rules are for 2022. So I can't say that this will be the same kind of case study going forward, but we were able to do an accelerated $1 million Roth conversion. What we started looking at for this client as we were looking to prepare this client from going from accumulation of wealth to distribution, and giving this client peace of mind. Can they retire? When can they retire? And they're looking at, retiring on a fairly early young side, which gives us a lot of flexibility in our planning. But we also looked at, can we accelerate a large one-time conversion and then maybe do some smaller future conversions? And what we did is we did some tax analysis, which I think we have on the next slide, which we'll show in a minute, but we were able to revise their living trust, do this Roth conversion. What you can see is these two things are not to scale. So this is an example of what we did with this client. We said, look, here's going to be the income taxes and estate taxes and income in respect of decedent taxes that your retirement, your heirs, everything's going to be subject to if we don't do a Roth conversion. Here's the comparison. By doing that Roth conversion, which we did some tax planning to offset their taxes, we actually did save them. They didn't have to pay that full tax bill. We did some complex tax planning in coordination with the CPA and with Jim and CunninghamLegal and the team. And in this particular case, you can see here that the client's going to be paying significantly less taxes. These are not even to the same scale. You can see over on the left-hand side, they would have been paying significantly more taxes. And cumulatively, we were able to save them over $7 million in that's just income tax. That has nothing to do with estate tax or IRD tax. So this is why the Roth conversion made sense, but we had to put numbers to test.
You know what? This is the classic example of this is a math problem. It's a math puzzle. You need somebody who's good at this kind of math, and that's Christina.
Oh, and it's our team. We have a team of certified financial planners. So it's not just me, but it's our whole office. We do a significant amount of, analysis that we're all equipped to do because we're all certified financial planners. We all have a focus on estate planning and tax planning. And our last case study was a client that is wanting to keep inherited investment property that was left in joint ownership with her cousin. And what we were able to do was, rather than, she wanted to buy her cousin out of the property. She would have had to, in order to buy her cousin out, she would have had to liquidate a ton of investments, recognize a ton of capital gains and taxes. And so what we did was I connected her with a mortgage broker. And I also was able to get her a discounted margin rate. We margined her account short term, was able to buy out her cousin. Then once the property was in her name, she was able to put a mortgage on it, put the money back into her portfolio account. And we were able to analyze all the cash flow of all of her real estate properties and suggest some different mortgages on different properties, and ultimately save her a lot in taxes and allow her to accomplish the goals without having to recognize a lot of tax consequences.
Okay, we'll open it up for questions. You will definitely want to subscribe to our YouTube page if you're watching this on YouTube. Anonymous asks, how did the ILET work in case study number 4? So
in this particular type of account, what we were able to do, sometimes our clients have RSUs, and RSUs can have some fairly significant capital gain consequences. If we sell those RSUs in a specific type of a tax efficient trust, we, in this particular case, created a charitable form of a charitable trust. That charitable trust will pay some income distributions to the client to pay the premiums for covering their estate tax for the life insurance policy for their ILET. So for the ILET, that will cover, it'll provide liquidity to the estate to cover the estate tax that will ultimately be due. We also were able to fund that ILET and generate a tax deduction to the client by selling RSUs that are highly appreciated without triggering a capital gain tax. So kind of complicated, but it took a team to really kind of go, okay, this client has all this appreciated RSU. What do we do with this? And we've got all these different varying problems. So if we can sell the RSUs in a different type of trust, gift them to a different type of a trust, exercise the sale of those in that trust, we can do so without triggering a tax and find a way to generate maybe an income stream to the client, pay for the ILET. So it was some fairly sophisticated planning, but this is again why you need a more comprehensive team, and that's what we do.
Yeah, RSU is a restricted stock unit. That's what that means. I will say, to close, Christina, this stuff doesn't happen on its own. You need to engage with your A team. You need to find those advisors. You need to pick them. And I will say, many of the people watching here, their advisors are probably either retiring soon or have already retired. And that's the feedback I get from many of our clients. And they say, the person I've used for many, many years, my financial advisor, retiring, CPA retiring, attorney retiring. It's just a function of demographics. So I would encourage you to go ahead and seek out your own A team, but definitely get an A team. Don't get a B team. Don't get a D team. Get an A team. It's too important. So with that, thank you, Christina, for spending some time here with us today. And thank you for watching.
Thanks, everybody. And if I think, Jim, you have the contact us too. So if anyone, we can subscribe to the YouTube channel, but then also if anyone has any questions or would like to reach out to us and do a complimentary consultation, certainly reach out to either Cunningham Legal or to Ascent Wealth Management and our entire team. We do work as an ensemble team, so that way we've got multiple heads working on each client case, and everyone here in our office is a certified financial planner. So happy to help in any way we can.
The question, Gar says, will you be sending the deck and recording out later to rewatch? This will be on YouTube. So this will be on YouTube for you to watch. So have a great day.
Thanks.